Welcome everyone, Jason here from Alliance Corp Property Experts. Got a great video here for you. This is one of the viewers asking, Jace, how do we reduce our capital gains tax liability? Good question, because capital gains tax isn't cheap. Now the fact that you have to pay it means that you must have made some money somewhere, so it's not all that bad. But if we have a talk about what CGT is, basically what it is, it's a tax that you pay on the profit that you make from the sale of an asset. Okay, so it could be shares, it could be property. You've made a profit, no different than when you're working in your job today, you earn an income, we've got to pay tax. So we all have to pay tax. Now, the beautiful thing about capital gains tax is that when you do make a gain, you actually get a discount, all right? If you're investing, if you've held onto the asset for longer than 12 months, the government will give you a discount. Why would they give you a discount? They're encouraging you to invest. They want you to focus on wealth creation. They don't want to pay everyone the pension when you retire. So that is a massive plus, because if without this discount, you'd be paying the same marginal rate that you're paying today, and it would cost you an absolute fortune. So there is a discount, there is a plus. So let's have a look at this example. Let's say you sold a property today, you made $200,000. You can also deduct a lot of your capital expenses before you end up with that profit margin. So let's say you've got $200,000, you apply the discount, so now there's $100,000 there of gain that you can be taxed on. Let's assume that this individual's earning $100,000 already in their job, right? So now they're getting taxed on $200,000. So the tax that you would pay on that particular return of $200,000 would be about $43,000, right? So in this example, it's 21%. So it would be a lot higher without the 50% discount, but it's 21%. So at a very high level, if you ever want to think about what capital gains will cost you, as a general rule, it's going to be around 20%, sometimes a little bit higher if you're on a higher marginal rate. But it's still significant. So let's have a look at some strategies that we can adopt to try to reduce this as much as possible. The first one is wait 12 months for that 50% discount, all right? Because that's the criteria. You have to have held onto the asset for at least 12 months to receive that 50% discount. I've had scenarios in the past where clients have come to me and said, look, I sold this property recently, we flipped the property, we bought it, we renovated it, we put it on the market again. I said, well, how long did that exercise take? Roughly 9 months. Well, had they just waited another 3 months before they flipped and sold it, they would have been able to access the 50% discount, but they just weren't aware at the time, and it actually cost them quite a bit in capital gains tax. Number two, purchase through a self-managed super fund. So yes, you'll have properties in your personal name, but there's also a lot of advantages when buying through a self-managed super fund. One of the biggest ones here is that the fund is only taxed at 15%, which is a lot lower than your current marginal tax bracket. Then of course, number three, move into the property. All right, move into the property at some point. There's a lot of people out there that are rent vesting, particularly younger people. They see the advantage of buying investment properties and renting until they're ready to get their home. But while you're doing that, there is an argument for you to at least move into one of those properties, because when you do, it becomes your principal place of residency. Capital gains tax doesn't apply for the period that you're there. But then when you move out, there's also this 6-year rule that means you also won't be charged capital gains tax for 6 years after you move out. Now that's provided you don't move out and then buy another home or have another principal place of residency. You could just be renting or staying with friends, etc. So another great strategy there to save quite a bit on capital gains tax. Number four, plan the sale dates of your properties. So remember, the capital gain, once they take into the discount into consideration, is added to your marginal rate. Now you might have a few investment properties there that you're looking to sell. You wouldn't sell them all in 1 year. You'd actually stagger the sale. So that's exactly what I did when I started my business. I sold off some of my properties, but I staggered the sale over quite a few years to reduce my capital gains tax. I didn't want all that gain being thrown onto my existing income at the time at a high tax bracket. So that's something you can think of, and particularly people who are looking to retire. You wouldn't sell all your properties just prior to retirement while you're still earning an income. You wait till you retire, you wait till your income comes right down, and therefore, again, that tax will be less. Number five, do you actually need to sell? So this is a good one too, because a lot of clients will call me up and go, Jace, those properties you helped us purchase, look, we've got equity in them now, and we want to get access to that equity, we want to sell some of those properties. But what we'll often find sometimes is whatever they need that equity for, there's also an argument that they just release the equity rather than sell the property. So they might go back to the bank provide their borrowing capacity is okay, and look at releasing some of that equity. It could be to cover a renovation on the property. If I've got someone that is going into retirement, they might sell some of the properties off, but just before they retire, take out some of the equity on the others to help sort of top up their income in retirement, etc. So you don't always have to sell, remember. It might be that you just release some of that equity where possible. So guys, there's 5 great strategies to help reduce your capital gains tax. But remember, capital gains tax is not a bad thing. I know a lot of people complain about it, but understand this, if you're making money, you've got to pay tax. There's no ifs or buts about it. The beautiful thing about investing in property is we get this 50% discount when we do. You don't get that today working for someone, okay? You don't get that 50% discount. So it is a good thing. You're only paying tax because you're making money, all right? So you're only paying tax because you're making money. But yes, there are strategies there. If you want to learn more about these strategies, book one of our complimentary property and finance coaching sessions. We'll teach you all about how to build a successful property portfolio, how to structure the finance, which areas to target, what type of properties to target, etc. And certainly go through a lot of this stuff too. I hope you enjoyed the video. Thank you.